Hey guys, Aaron here with Carnivore Trades. I want to talk about 5 gamma exposure mistakes you can't ignore. First, if you like the video though, don't forget to give me a thumbs up. Appreciate it. Helps out the channel, helps me out, and helps me to bring you the info. Also, if you would like to learn more about gamma exposure or swing trading alerts, live day trading room, come find me on carnivoretrades.com. Swing trading alerts analysis and live day trading. I want to talk about this video here. Been wanting to do this for a while, and I see a lot of, obviously, the gamma exposure GEX. It's risen in popularity meteorically over the last year or two, and for good reason. Now, even like these apps like Webull and stuff like that have like little Greeks and stuff like that. Um, I think maybe even Robinhood has them, and so on and so forth. But there's a lot of misinformation out there, and there's a lot of things that most traders miss, honestly. And I want to clear up those kind of misconceptions and really kind of smooth things out here. So, anyway, first mistake that I think is done very commonly is looking at volume, specifically just trading volume versus open interest, right? So, we're going to take a look at our dashboard here at Carnivore Trades, and you can see obviously we have OI here. There's our volume. And this is going to essentially represent, obviously calls and puts, the amount of volume that are trading through those intraday. The thing here is that I see a lot of channels, a lot of traders talk about volume as if that's kind of the main thing. It's actually OI, because plenty of times, I will see, a massive, I'm just going to use 5950 here, for example, a massive amount of volume intraday, right? Intraday. This is on ODTE. At a certain strike, but it's not even converting to open interest, right? So even like the volume here might be, just for example, it might even be more total exposure than the 5,900, which is the at the money. But if you look at open interest, it's smaller, right? And again, just as an example, just pretend. But if this isn't converting to open interest, like intraday, or if these numbers aren't lining up, if there's less exposure down here than there is on the OI, it kind of doesn't matter, right? Because it needs to convert into the totals, and like this is essentially where the dealer is going, what the dealer is going off of. So if somebody's telling you about, check this, this GEX level, and it's just volume based, you're missing data. You're missing a lot of data. I see this all the time. I mean, how many times do we gap up to 59.30, and then a bunch of ODT gamblers come in and they buy the 59.50 call, and then it just gets burned out. So the volume really, I mean, that could be call sellers too. So we don't have to go up to that level. In fact, we could also we could gap and crap off of that. So it's got to really be your LG1, your largest leg on the OI. And the volume here is just a tool to tell you essentially, all right, this is where traders are, a strike that they're targeting, right? And if that starts to really uptick in OI, we see like, oh, then yeah, we're probably going to go there. That's probably going to be a magnet. So that's really kind of the first mistake I see. The second one is, and it's kind of similar. A lot of these things are similar, but it is kind of just it's essentially using spot over total OI or the ODT. And essentially we'll just use unusual whales here. You can see spot, but essentially spot is kind of like, think of it as a weighted measure of gamma. So it's not just the front expiry. So let's say today it would be ODTE. That is represented here, but the next day, the day after that may be represented as well. And it's not unuseful. It's a good tool to understand. I think it's definitely worth looking at when you're at like a monthly expiry. Let's say it's Wednesday or Thursday, and you have a monthly expiry the next day of the Friday, or quarterly especially. Yeah, you can see a little bit of difference there and some variation. So it is worth looking at that next day. But honestly, the essence, what makes gamma exposure work, is the strike, right, is most sensitive the closer it is to expiry, right? So if you're looking at, and again, this goes out the same thing with the farther you go out. If you're looking at right now, if we're 3 weeks till monthly OPEX and you're going off that data, it's not that it can't work, it's not that it doesn't matter, but the closest expiry has the most weight to it. So I think spot has its place, but it can often be misleading. So I think the ODT, like for SPY, SPX, QQQ, ODT is really what you want to look at, unless you're looking, it's a monthly OPEX week and you're a day or two away from expiry. So I think there's a big misconception there. But essentially, yeah, ODT is the strongest, and it's the strongest by far. Like, it's really not even close. The third mistake is assuming that put and call walls can always be traded and will always hold. That is certainly not true. First of all, nothing is guaranteed in this business. There's always outliers. There's always things that can happen, and essentially we're odds makers, and we put the percentages in our favor. And if we're good, usually they work out. But we're going to look here. This is a Coinbase, and again, this is a little bit of a different look than what we've had before here. This was still kind of our terminal in beta, but essentially this right here to the right is going to be your net dealer, and the one in the middle is your regular dealer, hedging or tails. But this is actually knocking out two examples here in one. So again, your LG1 here, your call wall is 220 and then 220, 250, and then a little bit above that at 225, right? So into earnings, one would assume that's going to hold, right? Even though it's in, positive gamma territory and whatnot, that can still hold, right? According to, what people are taught, but that's not really always how it works, right? If you are in positive gamma territory, it can get run over. Also, and this is really what we do here at Carnivore Trades, what we developed the dashboard for, is we want to see the market from the complete dealer view here. So net dealer here, again, they're green, right? So they're not red, they're not equal at 220, 225, they're green, which means we can go right through that. And if we take a look at what happened on Coinbase earnings, it definitely went right through that, did it not? And it actually even held, and we actually gamma squeezed throughout that day. So again, there's plenty of examples. I can talk about Tesla's one that really, I wish I have the charts going back here, but like there was, on this particular run up here, there was, the 380 call wall, 400 call wall, 420, 440, 450, they all got blown out, right? When dealers are net positive, they can blow through that, and there's little signs you can see and look for that will tell you if they're, hedging a certain way, and looking to go through that. They don't care essentially if those levels blow out, right? They're actually prepared for it. So don't assume that a call wall or a put wall will hold. Again, positive gamma and negative gamma have a effect on that, which brings me to the next example. And again, flipping right back over here, which is that positive gamma is a license to buy and vice versa. Negative gamma is a license to sell. Again, not always the truth, right? Not the same thing. So if we take a look here, again, you can see in positive gamma, this is not a license to go short here. Right? You can see how the dealer is positioned, and they're long, right? They're willing to go through, let this go through that. So again, it's not necessarily a license to do anything. You have to understand the whole view here, and if you don't, you can get blown out very, very easily. So again, looking at the entire picture really matters. Again, these last three examples really tie in together, but number 5 is LG1 gamma is the most important thing, and it's really all you need to look at. It's not. One last thing, right, that I did not talk about yet, you probably see it right here. What is all this here? That is our, dealer exposure, we call it that. It's actually really like kind of a tail, our tail exposure. This is not small, right? This is not small at all here. And you can see, just because you have a lot here at 220, 225, it could hold, but they're prepared for it to go through that, right? And there's there's hardly any gamma up here. There's hardly any gamma exposure up here, but there's a ton of tail exposure. And again, flipping back over, you can see here on Coinbase, we went all the way up to those levels and then some. That one day, just for that one expiry. I mean, I think the expiry was a couple days after. So it went all the way up to 270. And I don't even have the view for that right now. I mean, this is an old chart that I posted in the chat. There's probably stuff up there, but you can see here, essentially, it gapped over that, I mean, it got literally gapped right over that. So again, you have to have the whole view, and you can actually, if we take another look here, we can actually look at, well, actually, you know what, before I even say that, I want to look at, I'm going to show you a tweet I recently did, but again, kind of going with the big picture here, you know, like actually pinned this to my profile, but if you were doing technical analysis, right, you wouldn't just look at one moving average. You wouldn't look at the 50 moving average and be like, oh, we tested the 50 MA, so it has to be a buy, right? You have to combine other things, right? Like, is there a bull flag? Is there, you know, a rising wedge? Is there patterns? Is there other things going on? Cycles, time counts, plenty of other reasons, right? There's many, you know, patterns, RSI. You can use all that stuff, right? So you're not just going to look at one pattern or one, you know, RSI divergence or one moving average and say, oh, it must be a buy, right? So why would you do that with? I'm not even going to say gamma exposure because like it's dealer exposure, right? Gamma exposure is one part of dealer exposure, right? And that's, you know, and a lot of these experts, the reason why I'm doing this video is because a lot of these experts, you know, so they say, only look at that, and, you know, they get themselves and others on the wrong side of the trade. So essentially kind of the big message here. But what I was going to say is you can actually look at, and we'll talk about Coinbase here. You can see the Friday before earnings. I believe they reported earnings on Monday or Tuesday, but this is the look, and I actually tweeted about this. Again, same kind of deal. You had 215, 215, 220. But again, there's your tails up here, 230, 250, 237, 250. So this was a few days before earnings, and they were hedged like that. Where did Coinbase go? Where did it gap up to when they reported? 231.49. So they kept right up to that wall and actually went through 250 intraday. So again, having the whole view is very important, and it's something that is, it's not just important, it's essential, especially now with the rise of gamma exposure and everybody kind of looking at these things, and just getting a hold of the data and the availability of the data is very important to understand exactly the full dealer view. Again, this is what we do here at Carnivore Trades. If you like this video, if it helped you out, helps you understand things a little bit better, drop me a like, comment your thoughts, subscribe to the channel. Come find me on carnivoretrades.com, and I will see you guys all in the next video.